In this week's video, we'll review the latest charts to help us answer the question, will spiking COVID cases trigger a bear market before the next leg higher? The video is broken into three main parts. We'll kick it off with fundamentals, the meat of the video is news studies, and we'll close with Friday charts. Let's talk briefly about intermediate-term stock market drivers. The AP declared Joe Biden the winner of the presidential election on Saturday, and before the open on Monday morning, November 9th, Pfizer came out with some very effective and encouraging findings relative to a COVID vaccine. Thus, the financial markets had a lot of new information to process at the open on Monday. Obviously, the vaccine news tends to be a positive. On the negative end of the spectrum, surging COVID cases and a new high in hospitalizations is really not what we want to be seeing relative to the virus. Given the somewhat conflicting outlook in the intermediate term, it might be helpful to look at some recent signals and see what we can learn about the probability of good things happening relative to the probability of bad things happening over the next few weeks, months, and years. This chart's a little noisy, but it's easy to understand. We're looking at a monthly chart of the S&P 500 relative to the price of a 30-year Treasury bond. In the ETF world, this would be somewhat similar to SPY divided by TLT. On the bottom of the screen is monthly MACD for the ratio. It helps us gain some insight relative to the longer-term conviction to own stocks relative to the conviction to own bonds. If you know your stock market history, you know there was a major peak in the stock market in the spring of the year 2000, and the new bull market really began in the spring of 2003, with the lowest low coming in October of 2002. You can see momentum, longer-term momentum rolling over here as the stock market's peaking. And then as the stock market's bottoming between October of 2002 and the spring of 2003, the momentum relative to this ratio starts to turn back up in a bullish manner. We can gain some additional insight by focusing on the zero line on MACD. When black MACD is above the zero line and black is below red, so this is a bearish cross here, signaling momentum rolling over. When it's above the zero line, we can somewhat treat it as a counter-trend move within the context of an ongoing uptrend. Once we drop below the center line, we begin to think of this move as the primary trend. You can see there was a similar situation when the stock market peaked in October of 2007. The ratio starts to lose momentum in here. In calendar year 2007, we get the bearish monthly MACD cross for the ratio, and then eventually we go into a longer-term downtrend with MACD dropping well below the zero line. During the European financial crisis in 2011, the ratio starts to lose momentum, but then turns back up in calendar year 2012. If you know your stock market history, the stock market, S&P 500, did quite well from early 2012 into the spring of 2015, and you can see momentum is turning up here, and we recapture that zero line. Primary trend in the ratio is up. At a major low in the stock market in early February of 2016, you can see momentum rolled over, and then in early to mid-2016, momentum started to turn back up. We rolled over again in late 2018, where all of the problems that we've been talking about began. This chart is dated November 12th of 2020. At the end of October, we had a bullish MACD cross in the books. And this cross is somewhat unique or rare in that black started from below the zero line before we got this cross. Therefore, this bullish cross here is different relative to this bullish cross here that occurred in 1998, 1999. This occurs well above the zero line. The damage in the conviction to own stocks relative to the conviction to own bonds is greater here than it was here in 1998, 1999. And if we look backwards here, we could have said the same thing walking forward from the mid-1990s. Since a turn up in monthly MACD for the ratio below the zero line and then seeing a bullish cross is relatively rare, it might be helpful to ask and answer. How many times has something similar happened since 1981? And what happened in the stock market walking forward? The answer is 6 previous times. And why 1981? Because we have data going back to 1981. And once again, we're using this simple but powerful concept relative to technical analysis and charts. These signals that occurred here are the past activity of some traders, and what we're trying to discern is what that may say about the future activity of other traders. This is the activity of some traders. Right here, you can see this, measure it, put it in a model. The same thing could be said here in calendar year 2016. And in each one of these historical cases, the past activity of some traders ended up being followed by additional bullish conviction to own stocks relative to bonds, especially on a longer-term time horizon. We had similar signals occur in 1994, 2003, 2009, twice in 2012. There was a little bit of a whipsaw in here. And then in 2016. Once again, if you know your stock market history, these are excellent risk-reward entry points for the stock market. Historically, 3 years from the date of the signal, worst outcome was a gain of almost 31%. The average gain in the S&P 500 was 46.2%. The median gain was 45.05%. This is the good news. The bad news is there was some volatility 2 weeks to 3 months out from the date of the signal in many of these historical cases. Thus, it might be helpful to understand what the maximum drawdown was in each case walking forward. This is the 7-week maximum drawdown in the S&P 500 from the date of the signal. You can see the numbers are identical looking out 1 year, meaning the maximum drawdown occurred in every single case in the first 7 weeks, and we never revisited those levels looking out 1 year, which also speaks to longer-term bullish probabilities. These drawdowns were calculated from the date of the signal. Thus, it's important to understand in the present day, we have to take that type of drawdown from the date of the signal in 2020, which was month-end October. The last trading day of the month was October 30th. Thus, it might be helpful to see what this type of drawdown would look like hypothetically in the present day. Here's where the S&P 500 was trading at the end of October. Therefore, the drawdowns are calculated from this point here, not this point here. These horizontal lines on the screen tell us historically, if an investor wanted to capture the returns on the right side of this table, they had to be willing to withstand somewhat gut-wrenching drawdowns in some of the cases. Here are the hypothetical S&P 500 levels in 2020 based on the historical drawdowns. These levels here are represented by the horizontal lines on the screen. Relative to where we were on November 12, 2020, this is a pretty significant drawdown. It's telling us it's within the realm of historical possibility that we could fall from over 3,500 down below 3,000 in one of the historical cases. That would be 2990. Right now, the 200-day for the S&P 500 is hovering around 3139. That would be about right here on the chart. Thus, relative to this study and the signal that we just received in 2020, it wouldn't be shocking to go back and test the 200-day moving average. It is within the realm of historical possibility. It's not a prediction saying we're moving back to the 200-day. It's just saying if we do, we shouldn't be shocked. And in the historical cases, patience ended up being rewarded in a big way. And since our focus is longer term, it's extraordinarily helpful to have data in hand that helps us keep realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. There's a lot of green on the right side of this table. We have very, very satisfying returns looking out 2 years in every case. Worst case scenario from the date of the signal, it was 19.43%. The average outcome historically was no picnic looking out 2 months. The average gain was less than 0.5%, and the median gain was less than 0.5%. And in 3 of the cases, the S&P 500 went backwards. If we take a big step back with the exact same ratio, so we're still looking at the S&P 500 relative to the price of a 30-year Treasury bond, it may be helpful with wrapping our head around returns like this going forward. It's been a relatively even battle from a longer-term perspective in terms of stocks relative to bonds. This is a very long-term period of consolidation. This is a bullish breakout above the level here that was in place dating all the way back to the highs in the year 2000. And we can make an argument that this bullish breakout here has now been followed by another period of relatively long-term consolidation and a successful retest. No market law that says the retest has to hold at the blue line and then bounce. Markets like to shake out as many participants as possible, and it's not uncommon to see a sharp reversal like that. Do we have anything else that's occurred recently in 2020 that might help us maintain a strong stomach should the market decide to backtrack? The answer is yes, and it comes in the form of study 2. Both the value line geometric index and the value line arithmetic index are composed of approximately 1,700 stocks, meaning they are very broad. S&P 500, 500 stocks. And the way the value line arithmetic composite index is calculated, it's an excellent way to track the activity of the average stock, which is another way of saying it's a good way to track market breadth. How many stocks are participating in the move? Study 2 focuses on the value line arithmetic index. This too is a monthly chart with monthly MACD on the bottom of your screen. End of October, we just experienced the second consecutive bullish close with black above red, and that too occurred after monthly MACD had dropped below the zero line. Thus, this cross here is similar. This bullish cross happens after we drop below the zero line. This would not check the box. This would not check the box. This is a much more oversold or bearish condition down here relative to this and this. And given this move here in the S&P 500 was the fastest bear market in U.S. history, that's not particularly surprising. The chart goes all the way back to 1998, and you can see a move like this, a bullish cross after dropping below the zero line, is rare. Therefore, it might be helpful to ask and answer. How many times has something similar happened since 1977? And what happened in the S&P 500 after the signal? The answer is 4 previous times. The reason why we're picking 1977, that's how far the data goes back on monthly MACD. Once again, if you know your stock market history, 1982, 1991, 2003, and 2009 offered excellent risk-reward entry points for a longer-term stock investor. In the historical cases, good things did happen for a long period of time. Looking out 3 years from the date of the signal came on October 30th in 2020. Worst case scenario, the S&P 500 was up 20%. The average gain was 34%. The median gain just a hair over 33%. We look at the right side of the table for study 2, and we look at the right side of the table for study 1, and confidently state, based on the facts in hand, that something that just happened in 2020, in this case at the end of October, aligns with, rather than contradicts, all of the information that we've been covering since early April of this year. How do the drawdowns look for study 2? If we look at them from the date of this signal, they're relatively muted. The average drawdown was just a little over 2%. The median drawdown, once again, just a little bit over 2%. But we have to keep in mind that the signal occurred on October 30th in the present day, which means we have to calculate that drawdown from down here, not up here in 2020. Therefore, for a longer-term investor to capture the gains in the right side of the table, based on history, it wouldn't be shocking for the S&P 500 to come back down near the September low again. That is not a prediction. It's just helping us understand a wide range of outcomes. And another way that this is helpful, if the S&P 500 trades down in this area here for a long period of time, that also helps us assess bearish probabilities. The same thing can be said for the hypothetical drawdowns based on study 1. The further we move in this direction, the more we learn about increasing bearish probabilities. From an implementation perspective and a planning perspective, it's always good to have guideposts to manage against. Now let's shift gears a little bit and see what we can learn from shorter-term charts from Friday's session. Somewhat of a mixed bag for the triple Qs right before the close on Friday. The good news is we're still above this upward sloping trend line here. Bad news, we're still somewhat in an indecisive range, haven't made a clear break above this line here. Similar situation at the close on Friday for the S&P 500. The somewhat bad news, this close right here is below this high that was made on September 2nd. So under this look, we're still inside of the trading range. The good news is if we look at closing prices, top of the range would be 35.80. This closed right here. We closed slightly above it on Friday at 35.85. Also somewhat constructive. After this ugly looking give back during Monday's session, we didn't plummet in this direction. In fact, we held above this downward sloping trend line here and closed above it during every session this week and pushed higher. After Monday's session with this type of look, this is really the type of look that we would have wanted to avoid. Doesn't mean we're out of the woods here, but this, and this is a lot better than this. Also noteworthy, rejected at the top of the range immediately. Not what we have here. On the closing look, if we drag this trend line down, draw it from here to basically here, we broke the trend line, then we made a higher low, and on Friday we printed a higher high. That increases the probability that this trend line break will eventually hold and will move in this direction. Here's Monday's session here. Here's the close. If you follow along on Twitter, you might remember on Monday after the close, we said the more relevant issue relative to market breadth was what it would look like in the coming sessions. During the give back session on Monday, breadth really didn't look that bad. A chart like this, new highs, new lows, this is dated November 13th, it's 2:09 p.m. It's really not going to predict anything. It's a monitor and adjust type chart. This, what we have here for the rest of the week following Monday's session, looks a lot better than what we had here in February. Nothing says this chart won't morph into something like this. That may happen next week, but it hasn't happened yet. So how did breadth look for the rest of the week? This looks pretty good. We did get some ugly numbers in the middle of the week, but here are the breadth stats right near the close on Friday. This is after the close. These are a little bit lagging here. But after Monday's sharp reversal, this is a good sign. What we didn't want to see was back-to-back-to-back ugly breadth days. More of a mixed bag after Monday's decline. Nothing particularly alarming at the close on Friday on this NYSE Advanced Decline Line chart that we've been covering. In fact, it printed a new high for the rally. Similar situation here, IEF SPY that we've been covering for several weeks now. We closed near the low for the rally. This isn't really indicative at this point of increasing economic fear. Like every other chart, it may change, but it hasn't changed yet. Close Friday, November 13th, high yield JNK relative to IEF. This is the type of downward sloping trend line here that occurred before the plunge in the S&P 500 in Q1. If anything, if we attach this high and this high, the slope of this line has been improving relative to the slope of this line, the slope of this line, or the slope of this line. JNK-IEF was up 0.45% during Friday's session. Nothing really new to report here. All of this consolidation in this W-type pattern. This is 1:53 p.m. on November 13th. We ultimately exceeded the top of the W pattern at the close, just barely above this high here. All of this consolidation has occurred above the 200-day moving average and above the 38.2% retracement based on this A to B move. Don't want to spend a lot of time on this, but you can pause your video player. If you're looking for a reason to keep an open mind about more volatility and the S&P 500 falling in this direction and staying in the range, which is obviously well within the realm of possibility, chart of the Australian dollar relative to the Japanese yen can help you in that area. 10-year yield late in Friday's session, 1:58 p.m. Eastern Time. Nothing alarming here yet. This chart of the VIX is as of 1:59 p.m. Chart actually moved a little bit further in this direction. It closed down 8.84% on Friday. Good news, we made a lower low here. Still somewhat concerning that this was a higher high. Like the somewhat unresolved price charts that we've covered, S&P 500, QQQ, the VIX has been bouncing around somewhat similar to this bouncing around here. If we got a move in this direction, a sharp move, obviously that would be concerning. But if we look at this here, notice the white space down here before this spike. Now we're starting to fill that white space. Right here, we shouldn't be down here. So this chart too, in a subtle manner, is leaning bullish for the stock market, but it still has not broken out, and it's still consolidating. And from a risk appetite perspective, Bitcoin trying to exceed the 2019 high. This chart is dated November 12th at 11:53 a.m. Our goal in a bull market is to make it to the other side of volatility events. Study 1 and Study 2 in this week's video would align with the fact that we should be in a bull market based on two of the signals that we just received. Study 1 and Study 2 tell us we shouldn't be shocked if the market backtracks in the short term, and thus far the consolidation that we've seen, it's all taken place above a flattish 200-day moving average, has been healthy. That may be subject to change, but so far it looks like healthy consolidation after a big move relative to the early stages of a new bull market. That's what the previous studies have told us following the March 23rd low, and there's nothing in Study 1 and Study 2 that contradicts that. It's probably the understatement of the year to say that the outcomes related to the virus are highly variable at this point, and that relates to positive outcomes, those positive outcomes associated with the development and distribution of a vaccine, and negative outcomes relative to the number of cases and the strain that we see on the U.S. hospital system in the coming weeks and months. Key takeaway is we haven't seen anything yet to put the longer-term outlook in jeopardy. Once again, that may change, but it hasn't changed yet. And if that change does indeed occur, and if that change occurs in a bearish manner, the only way that we'll be able to recognize it is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.